Welcome back. You're watching Your Money and Your Life. It's that time of the week that we look at stocks with the experts. Joining me now is Jun Bei Liu from Tribeca Investments and Superhero Trading App founder John Winters. Welcome, guys. We're going to take a look at Treasury Wine Estates, and Jun Bei, Australia's biggest wine producer, has been pressured over the last year or two, but a trading update, and it's everyone's favourite again. Why?
Absolutely. This is actually just the nature of the market, isn't it? So short term. The reason being that the share price was under pressure because China put a very significant tariff on the Australian wine, and its earning has subsequently been downgraded, and then everyone assumed no sale will ever go to China. But remember, Treasury is a business that has such a strong brand. Penfolds is something has been built over decades, and the consumer around the world, not just Chinese, has been loving that brand. So they have demonstrated that they could shift some of those wine that was selling to China into other markets. And in the US business, it's actually doing quite well at this point. So investors took a relook at the business itself. It is way too cheap.
Okay, so a buy now?
Absolutely.
John, what do you think of Treasury Wine Estate?
Yeah, I think there is a big assumption in the market that the tariffs from China are going to massively crimp sales. I think it is a bit of a free option, the Chinese market. So I'm saying it's a buy as well.
And next stock we're going to look at is G8 Education, the largest for-profit childcare provider in Australia, 472 centres around the country, big brands. John, what do you think of it, particularly with the new childcare subsidies that came in the budget?
Yeah, these sorts of businesses were really hit hard during COVID last year. There's very big tailwinds now with the budget coming through, a huge amount of industry support. So I think the signs are looking up for G8 and for the industry as a whole.
Okay. Jun Bei, 472 centres, community kids, world of learning brands. They're everywhere, aren't they? But it's a tricky balancing act, these childcare centres.
Absolutely. I absolutely agree. Childcare centres actually right now is in a good spot because government has provided so much stimulus for that space. And we're speaking to all the industry players. Occupancy is up and things are looking very, very well. Now, GA itself is something I would avoid because everyone, when they look for exposure to childcare, they tend to go for GA. And that has been the perpetual disappointer for so many years. And what the recent results have shown that they have lost market share to some of the other players. So much rather play the smaller ones, the Mayfair, the Evolve Childcare, and even the property trust that's exposed to that. But GA itself is a sell for me.
Okay, all right. How important is budget policies for different parts of the market? For example, big spending in childcare and infrastructure as well in this budget. Does that make a difference to the big providers in the market?
With the childcare, absolutely, because it's real money and real support for parents to use the services. So the overall sector should be supported. For infrastructure, it's interesting because it normally is long dated, so it takes time for those projects to flow through, and that is the issue.
Yeah. Buy now, pay later has been crunched a bit lately, has it? Is it a good time to pick them up?
For me, yes, absolutely, because its share price gone down close to 30% in the last week or so on the back of a bit of wobble across the Nasdaq, and we think there's every opportunity for those shares to do well. But stick with the market leader, and the market leader are the likes of the Afterpay and the top players such as Xero and things, so that will give you good returns over a longer period of time.
Okay, so this pullback, good buying opportunity. All right, you two, thank you for that. Good to see you.